Welcome to Operation Exit Liquidity, an intelligence series from HolloPoint Trading. We will discuss the $1.8 trillion IPO, the rewritten index, and the machinery of manufactured demand. The thesis in one line is a valuation of about $1.8 trillion for a company losing approximately $5 billion a year. The market's infrastructure was quietly re-engineered to force someone to buy it. Three key findings at a glance include a 15-day rule change forcing SPCX into the Nasdaq 100, $20 billion in public money pre-spent for a bridge loan repayment, and a $3.45 billion Bitcoin ETF outflow streak before the listing. Part 1. What is actually being listed? It is not the SpaceX of public imagination, but rather a conglomerate, assembled rapidly just before the offering. The listing includes 4 very different businesses under one wrapper. Starlink is the profitable engine. Launch is the moat and strategic crown jewel. XAI Grok is the capital-intensive story leg. And X Social is the monetization challenge drag and origin of the debt. The deal terms include a ticker SPCX, a target valuation of about $1.8 trillion, and a target raise of approximately $75 billion. This raise is more than 2.5 times the prior record, led by Goldman and Morgan Stanley with 23 banks in the syndicate. SpaceX's target raise of $75 billion is set to be the largest IPO in history, surpassing Saudi Aramco's prior record of $29.4 billion by a wide margin. Part 2. Lex SpaceX. The rules of passive investing were rewritten to accommodate this one listing, a fact found in the consultation documents. The rule change means that a TOP 40 listing now joins the Nasdaq 100 in just 15 trading days. The prior guardrail was a 3-month seasoning period to protect passive investors and ensure a real, liquid market formed first. The rule change, dubbed Lex SpaceX, was called out by NYSE's president, who stated that market integrity is not a competitive dynamic. The forced index entry is expected around July 6th or 7th, making it the real flow event. Part 3 is about the forced buyer machine. This refers to the passive money that must buy whatever the rule dictates at any price, exemplified by the $600 billion tracking the Nasdaq 100 index. The catalyst calendar from June to July 2026 shows the real flow event is the index entry around July 6th or 7th, not the IPO day. Trade the schedule, not the story. Part 4. Follow the debt. The banks did not stumble into the largest IPO ever. They built a runway to it and made sure they would get paid first. The closed loop illustrates how public money repays the banks. 5 banks lend $20 billion, which refinances $17.5 billion of XXAI junk debt. The IPO raises approximately $75 billion, repaying the banks within 6 months and also earning them IPO fees. The bridge loan of $20 billion refinances $17.5 billion of junk debt, effectively halving the interest rate from 12.5% to approximately 4.58%. The bridge, in numbers, includes a $20 billion bridge loan and $17.5 billion in retired junk debt. The new effective rate is 4.58%, and the IPO proceeds must repay the bridge within 6 months. Part 5. The numbers don't work. If we strip the narrative and value the company with its own figures, the spreadsheet does not close. Revenue grows, but losses grow faster. The company went from approximately $0.8 billion in profit to a $4.9 billion loss in 1 year, with an additional $4.3 billion loss in Q1 2026. The approximately 95 times sales multiple is detached from the balance sheet. This aggressive multiple is compared to profitable hypergrowth software, where it stands far above the rest. The gap called hope. The current annual net result of a $5 billion loss implies a significant gap to the $60 billion to $90 billion profit needed to justify a $1.8 trillion valuation. Reverse DCF suggests 3 scenarios. Only the coronation scenario, with sustained $60 to $90 profit, justifies the IPO, but it is the least likely. Part 6. The rotation has begun. To buy the largest IPO in history, the market must sell the largest amount of everything else. It's evident in the tape. The liquidity vacuum is created because to buy about $75 billion of a new stock, someone must sell approximately $75 billion of something else. This raises cash by selling liquid assets, like megacap tech and crypto. Part 7. The Bitcoin tell. Bitcoin ETF outflows show a record streak, with about $3.45 billion out in 11 sessions, even while AI and semiconductor stocks climbed. Bitcoin is about 45% below its October 2025 high. This indicates that the most liquid risk asset is being sold first when cash is needed, consistent with the liquidity vacuum idea. Part 8. The internals. A draining market still has winners, but they are fewer and more violently rewarded. Pay attention to the bifurcation within the market. The bifurcation is a rotation within the sector, where the market leader stalls while the equipment chain runs on the memory build-out. Part 22. One engine, three furnaces. Only Starlink is profitable, while it is strapped to three loss-making segments. Part 23. The real moat is launch dominance. This is the genuinely irreplaceable asset behind the whole story. Part 9. The topping rhyme. The current environment includes both the narrative blow-off of 2000 and the credit and oil catalyst of 2007, suggesting a market top. Is the current market environment similar to 2000 or 2007, or are we heading toward a 2026 scenario? The chart illustrates a potential climactic narrative surge followed by a give-back move. Part 18 focuses on the macro catalyst, specifically yields moving toward 5% and the risk of an oil shock. These are considered a duration killer and an inflation transmission mechanism. Part 21 outlines the four roads from here. The key is not to predict the road, but to define all four scenarios, watch the signals, and size your positions for survival. It is important to position for a range of outcomes, not a single prediction. 3 of the 4 potential roads could punish the hype buyer, with only one rewarding them. The 4 scenarios are melt-up, vacuum bite, climax and give-back, and macro break. Each scenario has specific confirmations and a suggested posture. Part 25 addresses both sides of the thesis. A strong thesis must have a solid answer to the counter case, point by point. The counter case, or Steelman view, presents a bull read and a bear read. The bull side focuses on forced buying, optionality, elastic liquidity, and good management in refinancing debt. The bull versus bear scorecard highlights key issues like the index rule change, valuation, the bridge loan, Bitcoin outflows, and who holds the risk. The bull weights hope, while the bear weights arithmetic. Part 26 presents the playbook. Don't predict the date, but define the triggers. Size every position so that being wrong is survivable. Watch the canaries like Bitcoin ETF flows and long yields. The real date is the index entry, around July 6-7th, not the IPO day. The discipline is to size small. Excitement is not edge. If you still want in, remember that the pop does not equal profit, as you are likely buying the post-pop price. Mark the lockup expiry, and always size small, planning for a reality bite scenario. The final takeaway: prepare and protect. The company is real, but the price is detached, and retail is at risk of being the exit liquidity. Size your risk so that being earlier wrong doesn't end your game.